Hello everyone, welcome to chapter 14. This week chapter is going to be about SMT divergences. Now this is one of the most underrated and crucial concept that is rarely ever talked about, right? No one really knows how to properly use it, and everyone that I've seen using it has used it incorrectly, right? So in this chapter my objective is going to be to explain everything about it so that you're capable of using it properly in your analysis and to generate trade ideas and to use it as a confidence for your pre-existing trade ideas. Now, SMT divergences can be used as a great tool for gaining conviction in your analysis and accurately predicting expansions and reversals, right? Now, one thing you need to remember is that I'm releasing these chapters in a proper chronological manner, right? From basics to advanced. And every time these new chapters are released, they are related and interconnected with the previous ones, right? And the later chapters are basically more detailed explanation of the prior ones, right? While at the same time I'm also introducing you to these other concepts that would be used in your analysis, right? The same way I've decided to introduce you to SMT divergence this week, because I think that it's the perfect time for you to learn about this particular concept so that you can then properly use it to gain conviction in your higher time frame analysis or even your lower time frame entries, right? Now SMT also considers key aspect of time, so it basically its significance increases even more, right? You will learn how to do that in just a minute, right? So let's move on. First of all, right here you can see this layout of these topics that I'm going to be explaining to you in this particular chapter. They're organized in a proper manner, right? We're going to start off with introducing SMT divergences, and then we're going to move on to the rest of topics like explaining symmetrical and non-symmetrical markets and so on. So let's start. First of all, we have to be familiar with what a divergence actually is, right? So, discrepancies or change in structure between correlated markets and instruments are called divergences, right? A divergence is basically when there is a difference, right? And there is a difference and discrepancy in market structure and order flow between two closely correlated assets. This is what we call a divergence, right? Now, when we are actively identifying these divergences and these discrepancies and variations at key levels and intervals, then that means we are using SMT divergences. Identifying divergences or these discrepancies and price at key times and key levels between two correlated assets with the help of ICT concepts is basically called SMT divergences, right? With the help of SMT, we can analyze two correlated markets and assets with each other and study their structure with each other, and then based off of that, we can potentially identify or spot discrepancies or variations, and then the type of variation and discrepancy or similarity will tell us about the potential continuation or reversal in the markets, right? Now, SMT signal potential continuation and reversal in the markets, right? That's the main important thing about SMT divergences. The last and most important point is that SMTs are used as a confluence for the already pre-existing trade ideas, right, in analysis. So that means you must never use it alone, all right, or you must never use it as a predominant concept or factor to form or generate a trade idea. It must be used as a confluence, right? We'll learn about that in just a minute as to why you should never do that. Moving on, in this slide, we're going to discuss what symmetrical and non-symmetrical market condition means, how does it work, and how we can use it, how we can use its core concept in our analysis to gain conviction. So, symmetry is basically defined as proportionate and balanced similarity found in two correlated or similar object or structures, right? Now, as we're using this particular term on our charts, right, in our analysis, so the definition for us would be proportionate and balanced similarity between two market structures, right, or two order flows between two correlated assets. The proportionate of that similarity or variation will define the type of market structure or condition that we are in, right? Now, symmetrical market condition occurs when two correlated assets, markets or instruments moves in complete symmetry, meaning it consistently keeps forming the market structure in order flow, right, without any discrepancy and variation, right? This type of symmetry and structure often leads to the continuation of price and a balanced price action, right? Because the market is moving in full symmetry without any disproportionate variation or discrepancies, right? That's what basically we call symmetrical market conditions. Now, these type of market structures and these type of market conditions are more suitable for the continuation of order flow in market structure, right? Now, what that means is, let's just say you have a drawn liquidity, higher time frame drawn liquidity at place. So if you use this type of market condition in order flow and that sort of framework, then it is going to be a lot higher probability for you because the market is following asymmetry and it is going toward a particular direction in a symmetrical manner, right? There's no manipulation going on by the market makers or smart money, so you can accurately and precisely trade it without any confusions or doubts. On the other hand, non-symmetrical market conditions are those type of market conditions in which there is a clear discrepancy and variation between the order flow of two correlated assets or markets, right? This type of market condition arises when two correlated assets or instruments moves in a non-symmetrical market structure and order flow, producing varying structure or different structure. This sort of symmetry in market conditions suggests that there is some sort of manipulation going on with the markets, and it basically signals to us that the smart money or the market makers are actively taking part and messing up with the charts and price action, and which potentially suggests that reversal, expansion, or explosive distributions could occur in the markets, right? Non-symmetrical market signals us that. Now, this discrepancy is called a divergence, right? And you would notice that before every reversal, expansion, or distribution of price, there's always a SMT divergence there at the top or the bottom, right? Depending upon the framework. Now, when you can accurately integrate it with other concepts and you identify an SMT divergence at a key level and at a key time, you can accurately and precisely predict expansions and reversals with the help of SMT while having a high margin of accuracy, right? SMT divergence is going to help you, this tool is going to help you to predict expansions and reversals in the markets at key swing points and at key levels during key times, right? That's how you can know when a particular profile is gonna end, right, and a new one is gonna start. Now, the main purpose of you knowing this is so that you are aware of the different type of market structures between two correlated assets, right, in terms of symmetry, and so that you can use this knowledge to be potentially be cautious and vigilant around price at specific structures in symmetry, right? It basically acts as a filter for you. It actually is a good filter for you to avoid lower probability conditions and differentiate between the two types of symmetry and the two types of structures based on symmetry. And with the help of this particular concept, you're going to make sure that you're going to only end up taking part in quick and explosive expansions or reversal with the help of SMT divergences, right? Now let's move on and let me explain this topic even with more detail. Right here we're going to discuss with some graphics symmetrical market conditions. So there are mainly two main metrics with which you're going to measure whether the market is in symmetry or not, right? If it follows those particular metrics and those particular filters and follows a specific theme, then that would signal that the market is in a symmetrical condition. And if it doesn't, right, and if it shows variant or different structure, then it would mean that the market is in a non-symmetrical market condition, right? Also, before I move on to explain this topic, what you need to remember is that we would be using two correlated assets and markets with each other, right? And not some random two pairs. You must remember that in these examples, I'll be mostly using the euro dollar and DXY graphics to explain SMT divergence because they're closely correlated with each other and they basically move in the same manner and with the same structure, but just inverted, right? Now these two pairs are correlated with each other. Their structure is basically always almost the same, right? The next part of this chapter, I'm going to give you some combination of pairs that you can use for finding SMT divergences while using it accurately, right? Okay, so with that being said, let me explain symmetrical market conditions to you and let me explain to you how can we determine that the market is in a symmetrical market condition, right? So basically, when the DXY or the dollar makes a lower low in its structure, and at the same time, a foreign currency such as the euro dollar or GBP USD makes a higher high, this means that the market is in a symmetrical condition. Let me explain. We know that when DXY makes a low, at the same time, a foreign currency such as euro dollar or EU, right? Just for the sake of this explanation, I'm gonna take EU as the foreign currency, right? We know that when DXY makes a low, Euro USD makes a high. This suggests that the market is in a symmetry because the structure is the same. Now, if you're gonna ask me that it's inverted, then that's because DXY moves opposite to foreign currency, right? So don't confuse inversion with symmetry, right? Both are different. Two markets can be inverted of each other, but they can still be in symmetry because they follow the same structure, right? And at the same time, the two correlated assets or instruments can have the same structure, but they can be in non-symmetry due to the difference between their highs and lows, right? So don't confuse the two with each other. So let me explain. When DXY makes a low, EU makes a high, right? Similarly, when DXY makes a lower low, EU makes a higher high. This suggests symmetry because both are moving in an inverted symmetry with each other following their structure. It may be in an inverted fashion, but they are following a symmetry because they are forming the same sort of structure just in the opposite or the inverted manner, but the structure or the symmetry is the same. This type of structure in order flow suggests that the current price action and the underlying order flow is likely going to continue, right? The way how you can use this idea is, for example, we are in a bullish market structure, right? And the order flow on Euro USD is bullish. We know that in a bullish structure, EU would reject below lows and break above highs and consistently moves higher while making higher highs and higher lows, right? That's basically how EU moves in a bullish order flow. Rejecting below lows and breaking above highs while also consistently making higher highs and higher lows. At the same time, we know that DXY is going to be in a bearish structure, right? And it will consistently be making lower lows and lower highs, moving in perfect inverted symmetry with euro dollar, right? And as long as this happens and as long as this continues, both the assets are going to be in a symmetrical condition. And this means that the underlying order flow or the underlying structure for both DXY and EU would continue, and there are no signs of reversals at the moment, right? One important thing is that currently we're talking about DXY and euro dollar as examples, right? But let's say you are an indice trader, right? Or a commodity trader, then to use this concept there as well, you need to be aware of this simple framework, right? That first of all, you have to take a benchmark asset like ES or gold and then compare it with an underlying asset such as NQ for ES or silver for gold respectively, and then you're going to compare the data and the price action of both of the charts, and then if you find any discrepancy between them, that would basically be an SMT. And if you don't find any discrepancy or variation, then that would mean that both the pairs are and assets are moving in symmetrical market conditions, right? So in this case, the benchmark asset is DXY, and I'm comparing it with the underlying asset, which is the foreign currency of euro dollar or EU, right? So remember that, right? Hopefully you got it. Now let's move on to the next slide to explain the second scenario of a symmetrical market condition. So another scenario for symmetrical market condition is when DXY or the benchmark asset makes a higher high, right? And the underlying or the foreign currency makes a lower low, right? This type of structure in order flow basically confirms symmetrical market condition, and it suggests that the underlying structure is going to continue, right? This is how you're going to determine whether we are in a symmetry or not. Now let's move on and discuss non-symmetrical conditions, right? So once you go through this part, then you can understand what is the difference between the two type of condition, what is the difference between symmetrical conditions and non-symmetrical, right? So when there is a discrepancy in variation in the structure between two correlated assets, that suggests non-symmetrical conditions, right? And such type of non-symmetrical conditions can be used for different objectives, such as accurately predicting reversals and expansions in the markets and so on, right? The way how we are going to determine and gauge and measure whether the structure is in a non-symmetrical market condition is following uh, through the following metrics and using the following framework, right? So in a non-symmetrical market condition, when DXY or the benchmark asset makes a lower low, the foreign currency or the underlying asset makes a lower high and fails to trade above the previous high. This is what we call a divergence and discrepancy in variation in price, right? And this suggests that there is an SMT, right? This type of non-symmetrical structure suggests that there is some tomfoolery going on and the market makers are actively taking part and the manipulation is going on. This type of structure does not confirm current price action, and it suggests us that the underlying structure in order flow is not likely to continue and maybe a potential reversal is on under the way, right? Now, the reason this is non-symmetry and the conditions are non-symmetrical is because DXY made a lower low and the foreign currency, which is EU for us, could not make a higher high respectively, right? And it failed to trade higher above the previous high and only made a lower high. Whereas on the other hand, DXY did indeed made a lower low and traded below the previous low, right? You can clearly see there is non-symmetry in the order flow in this, and the structure is varying and there is difference in structure, right? DXY was able to make a lower low, EU could not, and it failed to trade above the previous high, and it suggests non-symmetry, right? And this suggests that underlying order flow is not able to continue, and the reversal or a potential distribution can happen in price, changing the whole order flow and turning it upside down, right? When you see these types of sign in price, you're going to become cautious, trying to find. You're going to become cautious when trying to find continuation trades there, right? Because now the market has shown non-symmetry, and the strength of the underlying order flow has decreased significantly, and the reversals are potentially underway, right? So another scenario for non-symmetrical market condition would be the following: when DXY fails to make a when DXY fails to make a higher high, a foreign currency makes a lower low. This again suggests SMT divergence because there is a clear discrepancy in the symmetry of the price action between these two correlated assets or markets or instruments, right? If DXY failed to make a higher high, then the underlying or foreign currency should have also failed to make a lower low to continue the symmetry, but it did not, right? Because it made a lower low and showed a discrepancy, which suggests that there is non-symmetrical market condition in price and the underlying market condition is non-symmetrical, right? This type of non-symmetrical condition suggests that the underlying order flow is not able to continue and price does not confirms the current price action. Now let's move on and let me give you some combination of some important pairs and assets which you can use to find SMT divergence or discrepancies in price, right? That will potentially assist you in your analysis. So right here you can see a list of assets containing both the benchmark asset on the first half and then the underlying asset in the second half that you can use for finding SMT divergences between their price action. So if you're a forex trader, then the currency pairs you can use for SMT divergence are the following: Euro USD and GBP USD, right? You can use these two pairs because they are correlated. Similarly, you can use Euro USD and DXY. They are also correlated with each other. Only the only difference is that they are inverted of each other, but still they follow symmetry, right? So they're correlated. You can use USD GPY or USD CGF, or you can use the Aussie dollar or the New Zealand dollar, right? So if you're using the first combination of USD and GBP USD, then for that the example of symmetry would be when Euro USD and GBP USD together makes higher highs and higher lows, right? When EU makes a high, at the same time GU also makes a high. When EU makes a higher high, at the same time GU also makes a higher high, which suggests symmetry and continuation of order flow. Now, an example of non-symmetry would be when EU makes a higher high, but GU struggles to make a higher high and it only makes a lower high. This is what we call non-symmetry or non-symmetrical conditions, right? This is how you use it. So below we got the combination for other types of traders as well. If you trade gold, then you can use either DXY or silver for finding SMT. If you trade Bitcoin, then you can use ETH or Ethereum for SMT. If you trade ES, then you can use NQ for finding SMT divergence, right? As simple as that. Now, moving on to the next slide, here we're going to discuss how we can accurately identify and find high probability SMT divergences and avoid the lower probability ones, right? Now, the reason this topic is so important is because we've got two types of SMT. We've got true SMT that occurs at specific time and places, and then we got false SMT divergences that forms at random places, which serve the purpose of confusing and manipulating traders, right? If you trade every single CMT that you see on the charts, then you're gonna end up losing everything because that's not the correct manner to trade it. Your job is to use certain filters and metrics which will help you weed out the false SMT divergences, and you're gonna only end up with the high probability and high quality and true SMT divergences, which will eventually help you and assist you in your analysis, right? We've got different important filters that we're going to discuss in the next slide, but you have to remember that you must never trade every SMT, right? But rather your job is to use filters to only identify and accurately trade the true SMTs that have specific characters and that follows specific protocols, right? If the SMT doesn't follow these protocols and doesn't have these characteristics, then your job is to avoid trading them at all costs, right? Otherwise, you know what is gonna happen if you just pattern trade it, right? Just like every chapter that I explained to you so far in CPI, I've introduced you all of these different concepts, and then I've shown you how you can use them in a logical manner in the same way, in a logical manner, right? In the same way, I'm going to teach you how you can accurately trade SMT in a logical manner too, with a sound logic behind it, while trading it only when there is a proper high time frame narrative behind it and it has specific protocols and characteristics, right? Without trading at like a random pattern, right? That's not a proper way to trade it, because I know and we know that all of these concepts and all of this stuff is a double-edged sword, right? If you trade it like a pattern without some logic or any framework, then it's going to be a nightmare for you, and it will make sure you stay poor for the rest of your life and your children does not eat anything for dinner, right? But if you use it the way I taught you to, right, which is in a logical manner, around a logical framework with a sound logic behind it, then that will make sure that even your grandchildren doesn't have to work for the rest of their lives, right? So the point is that never to trade it like a pattern, and only use it and only trade it and identify it at key points, key levels and key times, right? It is certain market profiles, right? And a logical framework while having sound logic and narrative behind it. That's how you use it. So, in this slide, we're going to discuss the different filters and characteristics that makes an SMT divergence strong and a true SMT divergence, right? You can use these filters to identify high probability and high quality SMT. So, some of the important filters are the following. The first and the most important is that SMT divergences formed at key levels, specifically higher time frame key levels such as order blocks, FVGs, or important swing points such as highs and lows, right? This is the first important point, right? The best and the most important and high probability SMT and true SMT divergences are formed and produced at key levels and higher time frame key levels, right? If you're gonna find SMT divergence at a random place, then they're not gonna work, right? The only time they're gonna work is when they're formed at key levels, right? Write this filter down and make sure that every SMT divergence you find and you trade, it must have this characteristic. Otherwise, you should not use it or trade it. The next important filter is SMT formed at CRT highs and lows. Now we know that CRT are ranges, right? And the extremes of each CRT in high and low are high probability areas for SMT to be found. They're basically swing points, high probability swing points, right? So CRT highs and lows are key areas for SMT to be found. It's actually one of the main factor that confirms the CRT and actually leads me to select a high probability CRT. If a CRT has a SMT with a correlated asset, then that CRT is going to be a high probability CRT for me, right? Let's say we have two CRT on two correlated assets on DXY in EU, right? And what happens is that EU takes out the CRT high, whereas DXY isn't able to take out the low and it struggles to take out the low. This is a non-symmetrical condition, and this increases the probability of the CRT and makes it a high quality CRT for me. So that being said, the BIS CMT, SMT, not CMT, the BIS SMT are formed at CRT highs and lows, right? When one CRT is purged on one pair, whereas the other one or the other underlying pair isn't able to purge it, this confirms the CRT, and this sort of CMT as SMT, this sort of SMT is always high probability, right? Remember that. The third main important point is SMT, right? Divergence is formed at key times, right? Now we know that time is important in price. We must match key levels with SMT divergence, but also at the same time, you have to look for high probability SMT formed at key times, right? For example, during London Open, during 3 a.m. or during New York Open, you're only gonna trade these type of SMT formed at key times. If it's formed during the Asian session, then obviously you're not gonna trade it because that's not a key time for EU, right? For SMT to be formed or for any significant expansion or reversal to be occurred to be formed, right? And if you trade that sort of CRT formed at Asian session or during Asian session, then most likely they won't work, right? So to only end up with high probability CRT, you must look for SMT to be formed at key times and key levels, right? The next important filter that you can use is that SMT formed at previous week or day highs and lows, right? These are important swing points for potential reversals or expansions to occur in the market, right? SMT are most likely to be formed at such key swing points. Now, one of the most important thing you need to remember is that you're going to integrate and combine all of these concepts and the prime concepts with each other in a proper logical manner, right? With conjunction with each other, right? And you're never going to use it alone because obviously, if you use it alone, then that would be you just random pattern trading it. But if you use a logical framework to combine and integrate all of the other concepts like key levels, dealing ranges, market profiles, and so on, then that will make sure you're using it properly, right? That's how you properly use it. One of the most one another important thing about SMT is that you must look for SMT while targeting the higher time frame down liquidity. It has to be in that particular direction. If it's in the opposite direction, then obviously you're not going to trade it, right? You're not going to trade SMT formed at the counter direction, right? That's the most important point of this chapter. Identifying and finding SMT divergences in the direction of the higher time frame down liquidity, right? You must remember that. And there also has to be proper narrative built around it. I've discussed this before. Another important thing about SMT is that another important filter for SMT is that high probability SMTs are formed at key market profiles. What I mean by that is that the best SMT are formed during certain profiles, right? Such as the manipulation profile and the reversal profile. And price test a key level, and then that particular market profile such as the manipulation profile reversal profile occurs at a key time such as the London Open or New York Open, and with that it also tests a key level, and then there is a CMT SMT there. It confirms the manipulation profile, and what happens is that we see a discrepancy there between the two correlated assets, right? In their price action, and that confirms then now the underlying order flow is not able to continue, and we can potentially see a reversal in the opposite direction, right? And that confirms the SMT. And if you can then match it with a CRT there, then the probability increases even more, right? You can see that you're going to be using it like this analogical framework, right? Following a proper sound logic. Manipulation profiles and reversal profiles are high probability market profiles for SMT to be formed at, right, and produced at. These were some of the most important filters for SMT divergences that you're going to use when identifying SMT at key times and key levels at. If it's not following these filters and does not have these characteristics, then you're not going to trade them. Now let's move on and let's look at some examples of SMT divergence, right? These examples will help you understand this concept even more. So first example we've got right here is between EU and GU. We've got the EU chart on the left and the GU chart on the right. Right there you can see that both of were moving in complete symmetry until they reached closer to the key level, right? To the higher time frame key level. Right here around the key level you can see that both EU and GU made a high, right? What also happened with those highs is that that particular high of EU did not test a key level, but GU did. But what's sure is that both of them formed a high, right? Which means that they are in asymmetry for now. What happened next is that EU went higher to trade above the high that it made previously and made a higher high, whereas on the other hand, you can see that GU failed to make a higher high, but it instead made a lower high. So you can see there is non-symmetry between both pairs, and we know that this sort of discrepancy and symmetry does not confirm current price action, and it suggests that there is a potential manipulation going on and the underlying order flow is not able to continue, and that there could be a potential reversal, right? And you can see that after the discrepancy in SMT, the underlying order flow did not continue and price reversed from there and the reversal occurred. But you can also see that this particular SMT was formed at a key level, at a higher time frame key level. That's why it worked out the way it did, right? Another important factor could have been that this SMT was overall formed at a key time such as the New York Open, and that would have increased the probability of the SMT even more, right? This was like a really good example for you to understand the dynamics of SMT divergences. Now let's move on to the next example and let's discuss what we've got there. So here is another example of SMT divergence right here. You can see that we've got EU and GU charts again, right? And you can see that what's going on here is that EU and GU both first of all made highs, and after that what happened is that EU failed to make a higher high, but GU actually made a higher high, which suggests non-symmetry. And what happened is that it formed an SMT divergence, it confirmed the SMT divergence, and after that price reversed from there and a reversal occurred. This is how you could have expected a reversal profile, and you could have predicted this expansion. Another important factor here is that there was also a higher time frame key level right here, right above, which price tested. You cannot see it because I haven't run it out, but there was a higher time frame key level right here, which increased the probability of the SMT divergence even more. Another important factor is that the SMT divergence was formed at a key time during Tuesday and Wednesday, right? And after that, price expanded lower the rest of the week and had a weekly range expansion lower. Here is another example of SMT divergence right here. You can see that the divergence was formed at 5 a.m., which was a main factor behind this divergence, and you can now clearly see the dynamics behind this SMT. One asset, the benchmark asset, made a higher high, whereas the other one, the underlying asset, failed to make a higher high, which confirms non-symmetry, and a reversal occurred after that. Here is another important graphical representation of SMT divergence around CRT. You can see right here is that one asset purged the CRT high at a key time and tested a key level, but the other one did not, and it struggled to take out the high, which showed non-symmetry in the market turned into a non-symmetrical condition, right? And it increased the probability of this CRT even more. You would have traded this CRT right here, because it's an important CRT because of this SMT right here. Most of these CRT that I actually take, if you look closely at them and you reverse engineer those CRT, then you would notice that if you compare it with any other correlated assets such as G or DXY, you will see that there is an SMT there around that particular CRT. That's why I have so much conviction in those sort of CRTs, right? That's how you identify a high probability CRT through the help of SMT divergence. Right here, we've got another example. You can see on the left, we've got the benchmark asset, on the right, the underlying asset, right? Both of which are correlated with each other and have symmetrical price actions, right? What you can see right here is that after the CRT was formed, on both pairs, one of the asset purged the CRT, whereas the other one did not. And this again, you can see that showed non-symmetry, right, in price action. And you can see that the asset that actually purged the CRT went and moved on to reach the first target, and the CRT played out perfectly. And this was a high probability CRT because of the SMT divergence that it had. If you had seen this price action line, then you would have chosen and traded the CRT because it had an SMT divergence. Here is another example of SMT divergence at the extremes of CRT. You can see right here. Another one right here. One of the asset purged the CRT, whereas the other one did not, and price reversed from there, making it a high probability CRT. Now let's move on to some charts and let's look at some examples, some more examples. Right here on the top, you can see that you can see the NQ chart, and on the bottom we've got the ES chart, right? We know that both of them are correlated assets and moves in a symmetry. So our objective right here is going to be to find high probability SMT divergence at key times and key levels, right? And we're going to use the filters that I discussed with you earlier. So what you need to do is you need to look at the extreme swing points where explosive and quick expansions reversal occurs, and you would see that there is a SMT divergence there, right? You have a few seconds to point that out. Okay, let me give you a few seconds. Can you see it? Look at the extreme swing points where expansions and reversal occurred, and you would see that there is a SMT there. You have to find it out. Okay, 3, 2, 1. All right, right here you can see that right here we had made an all-time high on both ES and NQ, and what happened is that we were in a manipulation profile because we had formed these ranging profile earlier on both pairs, and then price purged those ranges, right, in these manipulation profiles. Now if you remember the previous topic, then you would remember that SMT are most likely to be formed at manipulation profile because they are high probability profiles for SMT to be formed at, right? And what you can see right here is that we were in a manipulation profile. We tested a higher time frame key level, right? And both ES and NQ formed an SMT there, and that SMT divergence showed discrepancy and non-symmetry in price action. And we know that non-symmetry means that the underlying order flow is not going to continue, and price is likely going to reverse from there, and expansion could occur in the opposite direction, right? And you can see that that's exactly what happened. Price reversed and expanded from there after SMT divergence, right? And that SMT signaled the top of the market. Also, if you are a diligent student, then you would also remember that right here, this is the monthly CRT high, price purchased that high, and then it reversed from there, which means the SMT was also formed at a key time and key level, a high time from key level, which was the monthly CRT. Here is another example right here. It's the shortest for you to identify the SMT divergence here. Again, to find the SMT, you know that you have to look for it during certain market profiles and at certain important swing points and key levels, right? You have to find it out. Can you see it? Let me give you some time. Okay, 3, 2, 1, enough. Right here you can see that we had a SMT divergence because one asset made a higher high but the other one didn't, and it showed non-symmetrical order flow, and the underlying order flow did not continue, and after that price reversed from there and from that exact point. And this is how you would have predicted a reversal in the market or a potential change in structure in the market through the help of SMT, right? This is how you use it. SMT should be formed at certain market profiles, at certain key levels, at certain particular times, and around CRTs, right? This is how you simply use it. Here is another example you can see. Moving on, you can see we had this huge SMT divergence, and price reverse exactly from that SMT, and the SMT was confirmed, right? I think those were enough examples for you to be able to understand the concept of SMT with clarity, right? If needed, you should watch this video again and multiple times so that you could actually understand all these concepts, like what symmetry and non-symmetry is, what both of them suggests, and most importantly, where and how to identify high probability SMT with the help of the filters that I gave you earlier, right? Moving on, in this last slide right here, we're going to discuss some important points regarding SMT that you must remember, right? You should write them down. The first point is that SMT divergences must only be used as a confluence rather than a predominant concept or factor for generating trade ideas, right? Next one is that identify and trade SMT at key times and at key levels. Avoid trading false SMT at random places, and you know how you're gonna do that, and which is by using filters. The best SMT are formed at higher time frame key levels at key times in the direction of the higher time frame drawn liquidity. And the direction of the higher time frame drawn liquidity, right? These are some important points that you must write down.